Hello traders, hope you're doing well. In this video, I'll be sharing with you 6 option strategies, 2 bullish strategies, 2 bearish strategies, and 2 strategies when market is sideways. So in all kind of market condition, you can use these strategies. Now some of you might ask me, if my view about the market is bullish, I will just go and buy an in the money or at the money call option. If the market goes as per a direction, I'll be making profit. And if I think market will move towards the downside, I will go and buy an in the money or at the money naked put option. Why should I learn these strategies? Many of you might have this question in mind, correct? So first, I will explain you the importance of learning these strategies. Then one by one, each strategy will be discussing. Now I'll switch to the screen and we will try to understand why strategies are important. Now traders, just imagine that there is a person called Mr. A. And for this person, we gave him a task. The task is to complete a 10 kilometers run without taking any breaks. That too, he has to complete this within 2 hours. And we have one more person called Mr. B. And for this person also, we give him the same task to complete a 10 kilometers run. But what we are going to do here is for Mr. B, we are going to give him some advantage. The advantage is he can take as many breaks he wants to complete this task, and also the time duration given for this person is 2 days. Now in these two, who do you think has highest probability of completing the task? Definitely Mr. B, because he is having time advantage and also he can stay in the race for longer duration. This increases the probability of him completing the task. But Mr. A has time limit. Because of this time limit and because he cannot take rest for longer duration, the chances of Mr. A completing the task here becomes very low. Now why did I give you this example? Because Mr. A is like an option buyer. Now let's say you think market will move towards the upside and it will give a 200 points move. If you take naked option, the time is against you, right? If market stays in a range for longer duration, even if market reaches your target, the chances of you ending up in loss is high because time is against an option buyer. And Mr. B is like option seller. An option seller, even if the market is holding on to a range for longer duration, there is no problem. Maybe it can take 1 or 2 days for him to reach the target before the expiry. If the target is achieved, it is okay for option seller. He will still end up in profit. But for option buyer, this is not the case. For him, movement has to be very quick and time is a restriction. Now traders, let us take cricket as one more example. Let's say the first 2 batsmen got out quickly. The third batsman, always what he tries to do is he will try to stay in the pitch for a longer duration because this will increase the probability of hitting more runs and winning the game for the team. Now the same rule applies even in stock market. If you enter a trade and hold that position for a longer duration, the chances of you achieving the target becomes higher. But what is the problem of option buyer? Time is against him. If market stays within the same range for a longer duration, or if it takes time to achieve the target because of premium decay, an option buyer will still end up in loss. Correct? One more problem is he cannot carry forward his position because our market is dependent on global news. Any negative news in US market will have significant impact on our market as well, right? So if market opens with huge gap down, let's say 100 points, 150 points, which is very common in the market these days. In that case, an option buyer, if you have just entered a call option or put option, you don't have any kind of protection. Overnight, when market is closed, you will not even be able to exit from the position. Next day morning, huge gap up, huge gap down, there is a chance that our entire capital will be washed out. Now to solve all these common problems what option buyer have, we have developed some strategies where we will be taking additional position. This will act as a hedge during uncertain situation. At the same time, these positions will help us stay in the market for longer duration. Staying for longer duration, what will happen? The chances of success will be higher. So this was the introduction. I hope you have understood why strategies are important. Now let's start discussing about all the strategies one by one. Traders, in this first session, we are going to discuss about bullish strategies. Before we discuss about the strategies, we need to understand why do we use bullish strategies. Now just imagine that Nifty is currently trading at 21,500 level, and from this level you feel Nifty will start moving towards the upside quickly and reach a target of 21,700. This means your view about the market is bullish. Normally, what a retail trader will do when his view is bullish, either he will go and buy an at the money call option which is trading at 21,500, or to be a bit more safe, he might go and choose an in the money call option which is 21,400. But one of the biggest problem of an option buyer when he chooses only one strike price is the time is against him. Now here you can see in situation number 1, if it quickly moves like this and the time taken for the market to reach your target is just 2 hours. Now we have second situation. Here also market has moved towards the upside, but the movement is very slow and the time taken for market to reach this target is 2 days. In both of these situations, you can see market has achieved the target of 21,700. But what would happen during the live market is, in situation number 1, let's say for example you bought a naked call option at 150 rupees. If the movement is very quick like this, by the time market reaches 21,700 level, you would have seen 100 points gain. The 150 premium which you entered would be now trading at 250 because the movement was very quick. But in situation number 2, the same 150 premium, because of time decay, even though it reached 21,700 level, which was your target, it will be trading at just 80 or 90 rupees. In both the situation, the market has moved as per your view. Only in the first situation you will be able to make profit. In the second situation, you will not be making profits. You will end up in loss. The main reason for this is because time is against option buyer. In situation number 2, the market took 2 days to achieve the same target. That is why if you buy a naked option, you will end up in loss if market quickly doesn't achieve the target. Now traders, this is where bullish market strategies comes into handy. Market can be bullish in two ways. In the first situation, market quickly it will start moving towards the upside and reach the target. But in the second situation, market takes its own time to reach the target. Now when you look into a chart and you feel the market has a potential of quickly moving towards the upside, we will be using a strategy called bull call spread. And when we feel the market is bullish, but the movement will be a bit slow, like situation number 2, we will be using a strategy called bull put spread. In bull call spread, just imagine market is at 22,000 and we expect market to reach 22,200. This is a movement of 200 points and you feel this movement can happen very quickly. That time in bull call spread strategy, you will enter two positions. First, you will buy one lot of in the money call option, and for your protection you are going to sell one lot of out of the money call option. Many retail traders, if they feel market will move towards the upside, they will take only one entry, right? They will buy one lot of in the money call option, that's it. But in this bull call spread strategy, we are going to protect our position by selling one lot of out of the money call option. Now without wasting any time, let me take you to the live market and explain about the strategy so that you can understand this better. Traders, let us understand bull call spread strategy with a live market example. Nifty is currently trading near 22,050. Now let's say my view about the market is bullish and I feel Nifty will continuously move towards the upside and it will reach 22,200 level. So this becomes my target area. Now in bull call spread strategy, what do? We buy a call option. Which strike price? In this case, either we can choose 22,000 or to be on a safer side, we can go up to 21,950 or max to max 21,900 strike price. So we are going to buy an in the money call option. Next, what we are going to do? We are going to sell a call option which is going to be out of the money strike price. In this case, our target as discussed earlier is 22,200. So we are going to sell 22,200 out of the money call option. Now what we are going to do is I'll take you to a tool where I will explain about what is going to be the probability of using bull call spread strategy if market quickly moves as per our direction. Now the website which I have opened right now, the name of it is Opstra. Just go to Google and search for this, you will find it. This is a free strategy building software. With the help of this, you can understand the probability of your trading setup when you execute multiple orders. Traders, once you go to Opstra website, here choose this option called Builder. Now the strategy example which we are going to do is in Nifty. We are going to add our position. You can see Nifty is currently trading at 22,042 level. Now our view is Nifty will continuously move towards the upside and reach 22,200 level. Now many people, what they would do at the current market price, they will only execute one order, which is they will go and buy an at the money call option or an in the money call option. Let us see what will happen if we do that. Nifty is trading at 22,040 level. So what we are going to do is we are going to choose option for the current expiry. Here if I choose an at the money strike price, I'm going to buy the call option. So if I add this position, let's see what happens. Now what you're seeing here, this is called a payoff graph. This graph represents at what level you will be profitable. If you just enter 22,000 call option, as per the graph, even after you enter the trade, it says that your break even. That means no profit, no loss. You will be at break even at only when market reaches 22,100 level. Nifty as of now is trading at 22,040. From here, it has to reach 22,110 for you to start seeing profit in the market. So at the current level also, if you enter an at the money call option, you will not be profitable as long as market reaches this area. Let's go here and click on option Greeks. If you choose this, here you can see theta is minus 40. For an option buyer, especially when you take naked option, theta value will be higher when you go for at the money or out of the money strike price. But before that, just look at what is the break even point. 22,109. Now instead of choosing 22,000 call option, we will go and choose 21,900 call option. We are going to buy this. Okay. And then we are going to remove this 22,000 call option. Now you can see what is our break even. Here you can see our break even has reduced from 22,110 to 22,098. At what price market is trading right now? It is trading at 22,040 level. So here still we have a difference of 28 points. Now since our view is bullish, we want the market to move quickly as per our direction. As per bull call spread strategy, we will choose an in the money strike price. We are going to buy it. In this case, we have already done this. Along with this, we are going to sell a call option which is out of the money, which can also be our target level strike price. In this case, 22,200 is our target area. So what I'm going to do right now is, along with this buy position, I am going to choose my target area strike price, which is 22,200 level call option. But instead of buying, I'm going to sell this. Now here, what you would notice is our break even has reduced significantly. Market is trading at 22,040 level, but we have 10 points advantage on our side. So from the current level, we will already start seeing some profit. From this, since our view is quick momentum towards the upside, if market continuously reaches our target area, we have a chance of making 8,000, and by adding the sell position, we have reduced our loss maximum to 6,700. By buying a call option and selling out of the money call option, what we have done is we have limited our losses in the market, and also the break even point has arrived to the current market level itself. From here, just around 20-30 points movement, quickly we will start seeing profit. You can look at this payoff graph. If Nifty reaches from 22,000 to at least just 22,100, our profit will already be close to 2,900 to 3,000 rupees. This I'm saying by buying 1:1 ratio, a buy position and one lot of sell position of call option. One more advantage of adding the sell position is if market holds on to this range to a certain extent, we are going to reduce theta because for an option seller, time is a advantage. So before I believe it was 41 or something, now you can see theta has reduced. Now in case you are holding on to this position for the next day, if market has reached only 50% target, from here even if it falls, you are protected at this area. I hope this is clear. This strategy is called bull call spread. Now, as per statistics, option seller are more profitable compared to option buyers because they have time advantage. They just have to identify a range. If market closes within the range, they will be profitable. But for an option buyer, we want momentum as per the direction based on the position that we have taken to be profitable. But why are people not selling option? Because it is expensive. But by implementing this strategy, you will significantly reduce the margins that you need to pay to your broker to add these positions. Now let us see what is going to be the margin for adding these positions. For this, you can go to Zerodha website or on Google you can search Zerodha margin calculator. This tool will give you an idea as to what is going to be the amount that you need to have to execute this strategy. On this website, if you just scroll down, choose the option market and select Nifty and choose the current expiry call option 22,200. This is our target, correct? If I just want to sell 22,000 and out of the money call option, you can see the margin which I have to have is 1,16,000. We are paying so much because there is no hedge for our position. In option selling, loss is unlimited, but in option buying, loss is limited. So as per the strategy, we are going to take two positions. Now we have added the sell position and now 21,900. All option we are going to buy. When I add this position, you can see the margin benefit what I've got is 94,000 because this buy position is acting as a hedge for me. So with just 22,000 rupees, I can execute this order. During the live market, to get this marginal benefit, please remember, you need to execute this buy position first. 22,900 in the money call option, we are buying this. After we execute this order, we are going to execute 22,200 call option. We are going to sell one lot. That time we will be getting this marginal benefit. So one of the biggest problem of an option buyer has been solved here. So as per the calculation, 22,000 is the capital that we are going to invest. Maximum loss will be 8,000 rupees if you hold on to this position until the expiry if market goes as per your view, and maximum loss will be 6,700. By implementing this strategy, you can hold on to your trade for a longer duration because the sell position is acting as a hedge. So let's say market close somewhere here. In case of huge gap down because of global news, still you will be protected and the maximum loss will be 6,700. So traders, I hope this is clear. This is our bull call spread strategy. When we think market will continuously move towards the upside, we are going to buy an in the money call option and sell an out of the money call option, which is also our target area. With the help of this strategy, your break-even point will become very closer. So quickly you can start seeing profit if market continuously moves as per your direction. This kind of advantage is not possible if you just execute a naked call option trading setup. Traders, I hope bull call spread strategy is clear to you. Now coming to the second strategy, when our view about the market is bullish, but we think the movement can be a bit slow. That time we will use bull put spread strategy. Here also our expectation is from 22,000 market will reach 22,200. But if I feel the movement is going to be a bit slow, that is when I'm going to use bull put spread strategy. Here also we'll be taking two positions, but the difference here is we are going to buy one lot of out of the money put option. Along with that, we are going to sell one lot of in the money put option. Now, why are we doing this? Let me explain the strategy with a live market example. It is now let's implement the strategy in the Opstra tool and look at the payout graph as per bull put spread strategy. In this, what we are going to do? We are going to sell an in the money put option. Along with this, we are also going to sell an out of the money put option. Let us implement the strategy. You can see Nifty is currently trading at 21,950. Maybe in the money what we can choose is 22,000. This becomes in the money, right? So this strike price we are going to sell first. So now I will choose 22,000 in the money put option. I'm going to sell this first. Once I add this position, you can scroll down and see. Only by adding one sell position, which is in the money put option, my profit is 7,500 approximate. But only this position, if you add, the loss will be undefined. Like I already told you, loss is unlimited for option sellers. So we need to hedge this position. In the current condition, you can see Nifty is trading at 21,940. From the current level, even if Nifty goes to 21,852, we will be at break even. But it becomes important that we determine our loss. So what we are going to do, we are going to hedge this position by buying an out of the money put option. So an out of the money put option can be, don't go too much out of the money. Maybe you can choose 21,900 or 21,850 strike price. Let us add this position. Always remember this in bull put spread strategy. The sell position premiums will be higher than the buy position. Here if you see the payoff graph, our break even is at 21,910. So from the current market level, we have got a 50-point advantage. At the same time, we have determined our loss. Before it was undefined, now it has become minus 3,000. Now instead of 850, since it is too far, we will edit this and choose 21,900 strike price. Even that is out of the money strike price, right? So 21,900 put option, we have modified this order. At this time, you can see our maximum loss has reduced and also our break even point is 30 points further from the current market price. So from the current level, even if Nifty falls 30 points, we will still be making decent profit in the market, maybe around 800 to 900 rupees. We will start incurring small losses when market goes below 21,930 and our maximum loss for this trade will be 1,500 rupees per lot when you add these two positions. Now while implementing this strategy also, to get the marginal benefit, first you will execute the buy position and next you will execute the sell position. So from the current level, even if market consolidates or hold on to the range and to achieve our target, even if market is taking time, by using bull put spread strategy, we have limited our profit. At the same time, undefined loss, we have made it limited and we are getting a 30-point advantage. So from the current level, even if market falls a bit, still we will be in break even. So traders, this is about bull call spread and bull put spread strategy. Both of these strategies we'll be using when our view about the market is bullish. Traders, now let us discuss about bearish market strategies. The market can be bearish in two ways. First, quickly it can move towards the downside, or it can slowly consolidate and then finally move towards the downside. In both of these conditions, market is moving towards the downside itself. The only point is, in the second situation, the market is taking a lot of time to reach the target. Now when we feel market will quickly move towards the downside, we are going to use a strategy called bear put spread. And if we feel market is going to move down, but the movement will happen very slowly after a lot of consolidation, that time we are going to use a strategy called bear call spread. Now in bear put spread strategy, we are going to enter two positions. The first position is we are going to buy one lot of in the money put option and we are going to sell one lot of out of the money put option. I will explain all of this with an example, so don't worry. Now coming to bear call spread strategy, where we feel market slowly it will move towards the downside. Here also we'll be taking two positions. First, we will be selling one lot of in the money call option, and we are going to buy one lot of out of the money call option. Now let us quickly discuss some examples of implementing these two strategies in the live market. This will help you to understand how to implement these strategies better during the live market. Traders, now we are going to discuss about when to implement bear put spread strategy. When do we implement the strategy? When our view is market will fall quickly towards the downside. Now this is a live chart of Nifty. Nifty is currently trading somewhere near 21,900 level. Now let's say I believe quickly Nifty will start moving towards the downside and reach 21,700 level. So this is a move of close to 200 points. My expectation is by the time of expiry, Nifty will achieve this target. Now in bear put spread strategy, we are going to add two positions when we feel quickly market will move towards the downside. The first thing we are going to do is we are going to buy an at the money strike price of put option or in the money strike price. In this case 22,000. Either 21,900 or 22,000 put option we are going to buy. And second, we are going to sell an out of the money strike price. In this case, what is our target? 21,700. So this strike price we are going to sell. Now let us quickly implement the strategy in the Opstra tool. We have chosen Nifty. It's currently trading at 21,879. So first thing what we are going to do, we are going to buy and in the money strike price. What is in the money strike price? In this case, we can choose 21,900 or 22,000. Between these three, let's say I choose 21,900 option because our view is bearish. This is an in the money strike price, correct? When market is falling, all the above levels will be our in the money strike price. This position we are going to add. So here you can see we have added this position. But the problem of only entering a put option trade here is our break-even point. That means no profit, no loss. We will come to this situation only if market is trading below 21,837. From the current market level, market has to move down by 70 points for us to see profit. So what we are going to do, we are going to add our sell position. In this case, we are going to choose an out of the money strike price. The out of the money strike price will be our target level strike price. In this case 21,700 because I am expecting the market to fall 200 points from the current level. Now I'm going to add this position. Now see what has happened here is I think I made a mistake here. I should change it to sell. Okay. Now if you see as per this strategy, our maximum profit is 7,000, maximum loss is 2,000 rupees, and our break even point in this case is 21,850. At the current situation, yes, we will be in loss. By the time of expiry, if market closes in this area, if it goes below 21,850, anywhere it closes, we will start seeing some profit in the market. Now let's say you're not happy with this break even point. Then quickly what you can do, instead of 21,900, you can choose 22,000 strike price. By doing this, what has happened? Your break-even point has gone even closer, where quickly you can start seeing profit if market starts falling. Now, some of you might say, for this trade, 6,000 is the maximum loss and profit is 8,000 rupees. You might not be happy with this risk reward. But please understand, you're not going to hold on to the position until the expiry. At somewhere, if you think, okay, market is continuously moving towards the downside, you can cut down your loss at 2,000, 2,500. But if market is going as per your direction, this will be the payoff graph. Loss, if you want to cut, let's say when market goes to 22,000, you're going to cut your loss. That time, your maximum loss is going to be just 2,500 rupees. So don't get tensed looking at this maximum loss limit. You fix a place where you want to exit the trade, where your loss is going to be minimal. If the market is going as per your direction, then hold on to the trade to gain maximum profit. Here you see, if market reaches 21,700, you would already see that profit. That means you don't have to hold on to the position until expiry, right? So this is how you need to think and decide your exit points for your trade rather than looking at this maximum loss. Cut your loss as per your risk capacity. So traders, this was about bear put spread strategy. Traders, now we are going to discuss about bear call spread strategy. Now, when do we implement the strategy? We use the strategy when we feel market from the current level, it will move towards the downside, but the momentum can be very slow before it reaches its target. That is when we use bear call spread strategy. Now, what kind of positions are we going to take? Nifty is currently trading at 21,900. Now, this becomes our first position, or we can also go up to 21,850. And in the money call option, we are going to sell first. Any one of these positions we can add, but if you take a sell position, what is the problem? Loss is unlimited. So we have to hedge this position by buying one out of the money strike price. In this case, market is yet to achieve 21,950 or 22,000. All these are out of the money strike price when it comes to call option, right? Any one of these position we need to go and buy. So these are the two positions which we are going to take. Now let us implement the strategy on the Opstra tool. So traders, in bear call spread strategy, what do? We take two positions. First, a sell position. In this case, we can choose at the money or in the money strike price. You can see market is currently trading at 21,900, around this, right? So what I'm going to do, 21,900 or 850 in this case. And in the money call option, we are going to take and we are going to sell this. Our first position is added. Now, if you scroll down, you can see in this, the profit can be 5,000 as long as market is closing under 21,550 before the expiry. Wherever it closes, maximum profit you will make is 5,000. But the problem here is loss is unlimited. So we need to hedge this position. For that, we are going to buy an out of the money call option. And out of the money strike price can be 21,950 or 22,000. So this position we are going to add. Now you can see what has happened here. By adding this buy position, our loss has become limited, but profit has also become limited. But the good thing here is the break-even point. 21,921. So from 21,921, by the time of expiry, wherever the market closes, you will end up in profit. And this buy position is going to act as a hedge for you. And like I said earlier, don't look at 3,900 as a loss. Let's say if market is going to, in this case, 22,000, the loss that you will be seeing is 1,500 to 600 rupees. If you think of exiting there, your risk reward for this trade will be 1:2. Now in this case, instead of 22,000 call option, let's say I go and choose 21,950 strike price. In this case also, our risk to reward is 1:1, but our break-even point will be 21,900. Traders, while implementing this strategy also, first you need to execute the buy position and then the sell position. Only then you will be getting the marginal benefit. So traders, till now you have learned 4 strategies, 2 for bullish market, 2 for bearish market. Traders, now we are going to discuss about sideways market strategies. Now the first situation, let's say market has been trading within a tight range for quite some time and you feel that at some point of time quickly the market can give a breakout and move towards the upside, or it can give a breakdown and move towards the downside. This means you are expecting the market to come out of this tight range, and the goal is to make profit when this kind of big movement happens in the market. During this kind of situation, we are going to use a strategy called the long straddle strategy. In this strategy, we are going to take entry in 2 positions. First, we are going to buy one lot of at the money call option and one lot of at the money put option. If you notice, both the positions are buy positions. Why are we taking buy positions? Because our expectation is market will quickly give a breakout or breakdown and come out of this zone, and we want to make profit when this big move happens after the consolidation. Now coming to the second type of sideways market. Here you have identified a range in the market and you expect the market to just consolidate within this range. Unlike long straddle strategy, you feel market is just going to stay within this range until the expiry. In this kind of situation, the strategy which we are going to use is the short straddle strategy. Here, we are going to take two positions, and both of these positions are going to be sell position. We are going to sell one lot of at the money call option and one lot of at the money put option. Now, some of you might tell me, so it's going to be expensive if I have to enter sell position in the market without hedge. But when I give you the examples, I will explain what kind of hedge you can have in the market. Also, only entering sell position, the loss can be unlimited. For that, what kind of hedge can we use and limit our loss? That also I'll be explaining next. Now let's see how to implement the long straddle strategy first. Traders, now let us discuss about long straddle and when to implement long straddle. We use this strategy when we feel market is currently at a tight range. Okay, let's say market is just consolidating within a range and we feel suddenly market has a chance of moving towards the upside or downside. We are not sure which direction market will move, but what we feel is market is trading in a tight range. Both the side movement is possible. In this case, what we are going to do is we are going to buy a call option just trading at the money strike price, and we are going to buy a put option which is trading at the money strike price. In long straddle, both the positions which we are going to take will be a buy position. Now let us understand the setup using the Opstra tool. In this example also, we are taking Nifty. Here you can see Nifty is currently trading at 21,920. So at the money strike price, let's say I'm going to consider 21,900. Now what I'm going to do here is I am going to buy 21,900 call option. Okay, I'm going to add this position. Along with this, I'm going to buy 21,900 put option. All right, I'm going to add this position. Now if you scroll down, you can see this is the tight range which I was talking about. As long as market is consolidating within this range, in both the call option and the put option which you have bought, you will be in loss. Only when there is a sudden spike towards the upside or towards the downside, that is when you can see big profits in the market. Here you can see by implementing the strategy, your profit becomes unlimited and maximum loss for the setup is around 5,000. As long as market is staying within this upper range and lower range, you can see this is the break even point. If market is within this range, because of time decay, you will lose. So you will have to use this strategy only when you're sure. After the consolidation, you can see a quick momentum towards the upside or downside. Now let's say there is some kind of news in the market where market is trading in a tight range. As per price action, if market wants to move towards the upside, it will first move like this and then consolidate for a while. Later, it can either move towards the upside or downside. And market is at a tight consolidation range. That is when we are going to implement the strategy. Once it comes out of this range, doesn't matter if it moves towards the upside or downside. When the movement happens quickly, you will start seeing very good profit with this strategy. Here you can see both the positions are buy position. This range is where market keeps eating our premium. Only when it comes out of this range, we can start seeing profits in the market. Now this was about long straddle. Now let us discuss about short straddle with the same example. We use this strategy when we feel market is going to just trade within a range for a longer duration. The goal is to make money when market is sideways. In price action, let's say market made a momentum like this and now it is just holding on to a range. This is when we are going to implement the strategy. As long as market is staying within this range, we will be profitable. Now short straddle strategy is just opposite of long straddle. In long straddle, what we did, we bought at the money call option and at the money put option. But in short straddle, what we are going to do is we are going to sell at the money call option and at the money put option. Let me show you with the same example. You can see this graph will change once I do this. Now I'm going to edit this buy position to sell position, and this put option buy position I'm going to change it to sell position. Now here you can see the payoff graph has changed. Now as long as market is going to stay within this range, you will be in profit. So by the time of expiry, if market is closing between 21,800 and 21,999, you can see that here. If market closes within this range, you will be making 4,900 profit. But one important point that you need to understand is both of this is sell position. When you enter a sell position, what happens? Loss becomes unlimited. So if market keeps moving like this, loss will become unlimited. If it moves up also, you will incur huge loss. Only when market is staying within this range, you will be profitable. Now, if you want to determine or reduce your risk by implementing this strategy, what you would have to do is, what is the break even point? It is 21,800. So if market goes below this level, loss becomes unlimited, correct? So here, to limit our loss, we are going to buy 21,800 put option. So I'll go here, I will choose 21,800 put option. I'm going to buy this. And on the call side also, if market moves towards the upside, my loss will be more, right? So again, I will go here. I will see what is the break even level, which is 21,992. I can go ahead and enter 22,000 call option. So here I will choose 22,000 call option, and this position also I'm going to buy. When you do this, you can see what has happened. Your profit has become 3,000 and your maximum loss is going to be 1,800. In short straddle, we are going to take two sell position. But when you enter sell position, loss is unlimited. To cover up that loss, we are buying a put option which is near the break even point, and we are going to buy a call option which is near the break even point. So by this, we are going to limit our loss. So this is about this strategy. This strategy can also be called as butterfly strategy. Now, since we already know loss is unlimited and the margin required to enter the sell position is huge, first we will implement the strategy on the Opstra tool. After doing that, we are going to protect ourselves first by entering the buy positions. After that, when we enter sell position, the margin requirement would reduce. Nifty is currently trading at 21,950. You will start incurring loss only when Nifty goes above 21,970. On the downside, 21,830. As long as it is staying within this range, you will be in profit. So this strategy we use when we think market is going to be sideways. Long straddle we use when we feel market will make a quick momentum towards the upside or downside, but we don't know the direction. So traders, these are the two strategies for sideways market. Traders, in today's session, we have discussed about 6 option strategies. 2 strategies when market is bullish, 2 strategies when market is bearish, and 2 strategies when market is neutral or sideways. Now, I would like to close this video by giving you some important points to remember. The first point, to implement the strategy, you need to first learn to read charts and understand the market sentiment. If you're not able to predict the market by looking at the chart, then you will not implement the right strategy. To improve your chart reading skills, you can follow our YouTube channel. Every day, we share Nifty and Bank Nifty analysis for the next day. If you follow our analysis at least for 30 days, I am confident that you can improve your chart reading skills. Along with this, you can also join our free Telegram channel. Here, every day morning, we share high quality trading setup for Nifty, Bank Nifty, and we also share setup of stocks which has high probability of giving breakout or breakdown. With the help of this, you can improve your chart reading skills. Now, second point is you need to practice the strategies which you have learned today at least for 30 days until you become comfortable. Without any kind of practice, if you try to implement the strategy in the live market, there is high chance that it can create confusion. So practice for at least 30 days until you get comfortable with the strategies. Now, point number 3, you need to always execute the buy positions first before the sell positions. Only then you will be able to get the marginal benefit. If you have less capital and you try to enter the sell position, your order will not get executed. Point number 4, please try to keep additional amount in your trading account than the capital which is required, because sometimes due to market condition your broker will automatically square off your position if there is less funds in your account. So at least try to keep 20 to 30% additional capital in your trading account apart from the capital used for entering the trade. One of the most important points is do not hold your trade until maximum loss. I have explained this while discussing about strategy. Please plan your exit as per your risk capacity. If max loss is around 8,000 but your risk capacity is just 2,000, then it is better that you exit your trade at that time. Now, one of the most important thing is please understand trading in financial instrument involves huge risk. First, try to understand your risk appetite before you trade in these instruments. Traders, now we have come to the end of this video. I hope you found this useful. I have tried my best in explaining these strategies as simple as possible. I'm sure you would have noticed many times I would have repeated the same point repetitively. This is only to ensure you do not ignore important points. Traders, thank you so much for watching this video. If you enjoyed this content and you think you learned something new, then share your support by liking this video and subscribing to the channel. If you think this kind of content will be useful for your friends, please share it with them. Now that's all for this video. I'll see you in the next one.